I'm Holly Miller with Guilds with Benefits, and you're watching Home Buying for Solo and Small Business Owners with Beth Dillight and Julie Felsman. And we'll kick it off and get started.
Fantastic. Let me share my screen. All right.
Yeah. Welcome today. I think I'm the first one up here, so I'll introduce myself. My name is Beth Dillight, and I'm with Urban Nest Realty. The photo here is my co-agent and husband, Ryan Dillight, and we offer home buying services, both buying and selling in the Portland area, but all of Oregon as well. And we also do some commercial tenant representation as well.
And I am Julie Felsman, and I'm a residential loan officer also based in Portland, Oregon. However, I am licensed to lend in all 50 states. I, like Beth and Ryan, do a little bit of commercial, kind of mixed use commercial and dabble in that, but my specialty is residential, and that will really be the focus of our conversation today is kind of residential real estate transactions and financing.
So I think I'm talking about why are we here? So Julie and I, intersect a lot with the business world. I am a board member for the St. John's Boosters, and so I interact with small business owners a lot, and Julie does as well in the lending side. And we kind of realized that a lot of folks just it's already kind of tough to buy a home. It feels intimidating. And then when you add in the fact that taxes are a little more complicated when you're a small business owner and income's a little more inconsistent, we kind of realized that folks felt like home buying was even that much further out of reach for them. And so we thought we'd put together a class to kind of, help with some of those questions that you have and help you see that there is a path to it. Like, is it complicated? Sure. But is it possible? Also, sure. So that's what we're trying to cover today. And a lot of it's going to be Julie. I'm going to pop back in a couple times later on in the session, but really the big questions surround the financing. So I'll let Julie take it away.
Yeah, I'm going to probably spend a lot of the time talking about, the financial and mortgage side of things because it is such a big focus for anybody, but particularly for somebody who's an entrepreneur, solopreneur, self-employed, freelance folks. And I will say, and I mean this from absolutely the bottom of my heart, it is my belief that no self-employed person is more than 2 years away from being able to purchase a home. Maybe closer, but no more than 2 years with appropriate planning, which again, in the spirit of what Beth was saying, is a lot of why we put this information together, why we're excited to share it with you all, is that, if you listen to, the negative voice that, all the negative voices out there telling you you're never going to be able to buy a home either, period, or because you're self-employed, because you're a solopreneur, and you never start that planning process, then you could always be 2 years away from buying your home. And so, we hope this will be a little bit of a catalyst for that. That said, if you feel like you're the black sheep and that, buying is going to be a little, different or trickier, or maybe, the rules weren't made for you, you're not imagining it. There are definitely some things that are different for people who are self-employed. There are also some things that are just the same. And I have often said that, any mortgage is sort of like a three-legged stool. And there are, when we qualify someone for a loan, 3 elements that we need to look at: your assets, your credit, and your income. And I'm actually going to run through all 3 of them. And I'm going to knock out the ones, this kind of triumvirate of information that we gather from folks when they're thinking about purchasing a home, really combined to generate that loan approval that you can go out there and shop, find your home, and purchase it with. And Beth's going to talk about that process in a bit, of course. But I'm going to start by talking about the things that are pretty much the same for any home buyer, whether you're self-employed or not. And one of them is assets. Obviously, you've got to have some money to get in the door to a home. And there are just a few loan types that we use for residential purchases. If you're a veteran or buying in a rural area, there are 0 down payment loan options where you don't need a down payment at all. If you're looking for a loan that, if you're not a veteran and you're not buying in an ex-urban area, then there are some lower down payment options. 3.5% down is the minimum down payment for an FHA loan, what we call conventional conforming mortgages. And conforming mortgages are probably about 70% of the mortgages that lenders offer to folks. It's the majority of loans that we close. They require 5% down if you're not a first-time home buyer, but if you're a first-time home buyer, you only have to put 3% down. And then if you're looking to borrow a larger amount of money, and the line in the sand, depending on when you're watching this may be different, but for 2025, the line in the sand between what we call a conventional conforming, and a jumbo loan amount is $806,500. So if you want to borrow more than that, that's called a jumbo loan. And the minimum down payment for those, there's some exceptions to this, but really usually is going to be 10%. Now, if that 3.5 or 3 or 5% down feels challenging, you might be happy to hear there are down payment assistance programs that can help offset some of that and bring the amount of money that you have due at closing down to zero. And there are a ton of down payment assistance programs. So if you're feeling like, this cash to close is going to be a struggle, then don't let that stop you from reaching out and having a conversation. We can see if some down payment assistance programs are available to you. Now, on top of the down payment, there are 2 other things you have to pay for, and those are transaction expenses and then an initial installment of the recurring expenses of owning your home, what we call prepaids, which are some taxes, insurance, and interest for your mortgage for the first month of closing. And those can be another, if you're buying in Oregon, 3 to even 4% of the purchase price. So there's an element of additional money that we need to find or budget for somehow. This money can come from a ton of places. Obviously, if you've got savings, if you've got assets you can sell, if you've got gifts, you've got stocks you can sell or what have you, cryptocurrency, etc. These are all sources you can dip into your business funds. I put kind of a little caution tape around selling personal property, like I don't know, vehicle or an antique or something like that, and cryptocurrency and business funds, just because there's some extra rules to make those viable. But these are all available options. And kind of the only places, the list is much shorter of things that we can't use. Unsecured loans aren't permitted as a source of funds for closing, which is to say you can't just take an advance on your credit card to fund your down payment or closing costs. And cash on hand is not inherently a problem. If you operate a business that's cash-based, tattoo shop or something like that, there's a possibility you have a lot of cash in your life. The trouble with cash is just that we lenders like to document things, and it's tricky to document cash. And so I put cash in kind of the red light zone just because we can't paper trail it. It's easy to fix that with a little bit of time. This is another place where I'll say this a lot, where planning ahead is really helpful. But it's also valuable to know that we've got these down payment assistance programs that can help offset some of these costs. And depending on the market in which you're buying, you can ask the seller to contribute toward paying some of your closing costs. And Beth, I'm just going to put you on the spot because, when I talk about down payment assistance programs, I always think about your home purchase with Ryan. Do you remember how much money you wound up having out of pocket for the whole kit and caboodle?
I'm exaggerating to say that it was about $4,000. That was it. So
pretty nominal. And it was a down payment assistance program we used.
It's a down payment assistance program, and then with our, closing costs, we got a few credits from the seller, and it just was a lovely mishmash of things that led to it only being about $4,000 out of pocket, which is awesome. Yeah. Julie, your camera did go dead.
I noticed that. I'm going to have to do that off and on. It's I don't know. Teams and my equipment is a little touch and go. And actually, while I've roped you in to talk about things, I know this is one of your very favorite things to talk about. Do you want to talk about the pizza math, or would you like me to?
I can do it.
All right. Okay. Do it.
Yeah, pizza is one of my very favorite things. So this is also, favorite in a couple of ways. But kind of the goal behind the pizza math is that when you're saving to buy a home, it's really hard to know, how to get to that point. And it feels very overwhelming, and there's a lot of money that you need to have, but little tiny decisions can really add up to a lot. And so, once I finally sat down with Julie and kind of had a goal number in mind, it was a bit more than 4,000. We just, got to shave a little bit of that off. But when I had the goal in mind, it was a little easier to make that decision to maybe I don't take that weekend trip. Maybe I don't, go to that concert. Maybe I don't buy the pizza, that can help me save a little bit more toward a down payment. And so this is the pizza math that basically every amount that you can kind of save. So that pizza, let's say it's $50. If you divide it by that 0.03, that's about the savings of $1,667 toward your down payment $1,667 of house as related to a down payment. I did that really poorly. But anyways, yeah, it
really adds up. And I think it's a good way to make those little decisions, right? If you're like, do I want this or do I want that, right? If this that you're looking at needs to be somehow translated into that of the home you'd like to buy. Most first-time home buyers put 3% down. So divide by 0.03, the $100 divided by 0.03, and you can decide, do I want the thing I'm about to spend $100 more than I want $3,300 of my new home, right? And those little decisions really do add up pretty quickly to help fund a down payment, especially when we've got down payment assistance programs and we might have seller credits and other things that we can do to help minimize that amount of money you have due at closing. Historically, this has been the big hurdle for purchasing a home. Anytime folks that want to buy a home and haven't bought a home have been told, the down payment is the big thing. And so we definitely want to emphasize, there's a lot that we can do to chip away at that. Which really brings us to the next leg of our stool. We want to talk briefly about credit. And if your credit is less than perfect, that's okay. There are loan programs. The FHA loan, which stands for Federal Housing Administration, a VA loan if you're a military veteran and eligible, or if you're buying in an ex-urban area, more rural area, USDA is a program that all of these programs are very, very flexible when it comes to credit scores. You can have far less than perfect credit and qualify for a loan. And when we shift over to conventional loans, which again are the lion's share of loans that we fund, there's still some flexibility to have some blemishes on your credit history, have credit scores that are in the 600s, and still qualify for these conventional loans. Now, you do get loan terms get a little better the higher you go, and optimally we love to see credit scores in the high 700s, but that is absolutely not necessary. And talking to a lender is one of the ways you can improve your credit score. We have a lot of tricks up our sleeve that can move the needle on credit scores a little bit. And again, jumbo loans, those larger loan amounts, as you might intuit, you may want to see a little stronger credit if you're going to be borrowing a larger amount of money. And the only other thing I want to throw in there with credit, we're not going to talk about this a lot. Oh, my camera's acting up again. Let me see if I can get it to behave itself. So the only other thing I want to mention when it comes to credit is that the credit score that you're watching, that you're monitoring, probably isn't the credit score that you're going to see when you apply for a mortgage. We are going to use an older score model that's a little bit different formulation for credit, and it's probably going to be 10, 15, maybe 20 points lower than what you're used to seeing. And if you talk to a lender and you see a credit score that looks lower, that doesn't mean anything bad happened. It's just a different recipe for calculating that credit score. And that brings us to the big topic, which is income. And that is always the interesting puzzle that we get to solve for our self-employed, solopreneur, freelance, entrepreneurial clients. So what the heck is it that lenders are looking for? Well, we want to see stability in your income. We want to know that your income is going to continue because we're making a loan to you that you're going to have to pay on for years and years, right? We want to know, okay, there's going to be income into the future. And then we want to know that we have paperwork that we can trust where we're getting that information, right? Those are the things that we're looking for. And I'm not going to lie, there are some challenges. There are some things that we need to figure out. And one of them is that what you think you make is not necessarily what we're going to think you make. It is not what you're earning. It's what you keep. And I want to say, I sometimes joke that I'm the black sheep in my family. I had a black sheep slide earlier, and I feel like the black sheep in my family because I think I am the only person in my family. If I think back on my mom's side of the family, 3 generations back, as far as I know, every single person in my family, including my siblings and parents and step-parents and everything, are all self-employed. I am the only person that isn't. I get a W-2 and nobody else in my family does. When I was growing up, the business that we had, one of my family's businesses was cabins in the mountains in Colorado, in the little mountain town I grew up in. And I just want to say, I understand that you're writing everything off. The toilet paper on the screen, I literally wiped my tushy with a tax deduction when I was growing up. We never bought toilet paper. We went down to the storeroom with the cabins that were down below our house and grabbed toilet paper from the cabins. Like, I get that a lot of times you are obviously going to do everything that you can to deduct everything possible and minimize your tax bill. And, it's a little bit of a catch-22, because the better job you do at that, the less income that we're going to see for loan qualifying purposes. But there are some answers to that. Another puzzle that we really have to deal with, and depending on your particular circumstances can be a little tricky, is we're going to use the past to predict the future, right? We want continuance and we want stability. We don't have a crystal ball. So we got to look backwards at what has happened with your income to figure out what we think might happen into the future. And that means that we're going to be doing an average of income over time, usually what I call a worst case average of 2 years. So if this most recent year was great, and we're going to look at 2 years, then we're going to average the not as great and the great year together to figure out what your monthly income looks like. But if your income went down a little bit, then we have to talk about, okay, well, is there a problem? That's kind of one puzzle, one thing we have to talk about. But also, we're not going to look at the great year and average it in with this year, which is lower. We're going to look at just the most recent year of income tax returns. And it really makes tax season, and we're recording this in the fall, so everybody's, we're kind of getting close to the last quarter when everybody's thinking about, kind of prepping for taxes at the end of the year. And that is your one shot a year to tell the story of your business, your financial story, in a way that lenders are going to see when they look at your income tax returns. And that's it. You don't get to tell that story again for another whole 12-month cycle. And that's very different than for people who are W-2'd. If you got a raise or something happened, we can see it in real time and use it in real time. And we're not having to look back at tax documents, because really we trust those tax documents. We trust that what you're telling us, telling the IRS, is something that we can trust to use for loan qualifying purposes. And it just means that there's a pretty long tail. I'm talking to a client right now who's a self-employed real estate broker about a mortgage, and she hasn't yet filed her 2024 income tax returns. It won't be due for about another month. And here it is in September of 2025 when we're recording this, and I'm going to be qualifying her off of 2023 and 2022 income. That is, can you even remember 2022 at this point? We were still coming out of COVID. It was a blur for me. And that's the documentation that we're going to be looking at, or part of the documentation we'll be looking at for that loan. So it just has a really long tail. And then if you're a freelancer, and these platypi are near and dear to my heart because I'm married to one of them, and you get a mix of W-2s and 1099s, and you're sort of not really in one category or the other fully. If you have a foot in both camps, that gets a little complicated, and it doesn't necessarily fit neatly into loan rules. But there are solutions to all of these things, or what I like to think of sometimes as cheat codes. And the first of them, and we're going to get a little teeny bit in the weeds here for a second. The first of them is, when we look at your income tax returns, you might be writing off your toilet paper like my parents did, but we are going to go through and we're going to look for some adjustments. And I'll explain kind of a little backstory to this, but we're looking for depreciation, and some of that might come in the form of a vehicle. When you put an asset into business use, it isn't the same thing as using up something. If you drove across town to meet a client and, you burned gas and bought lunch or something, those are things that were just an expense, right? But if you buy a laptop, that's something you can use over and over and over again. But the IRS will let you write those off in the form of depreciation. If you're using your home for business and deducting that, that's another adjustment we can look at. And there are a couple of adjustments. If you did drive across town, buy lunch for a client, and the IRS didn't let you write off that full lunch, the full cost of lunch, which is sometimes the case, we have to make an adjustment for that too. And why is that? Well, the reason for that is that they say cash is king, but in lending, it's really cash flow that's queen. We're trying to look at those tax documents that you give us, or the other information you give us. There's some other options, and we're just trying to figure out your business's cash flow. Money comes in, money goes out, what's left over. And that cash flow is what we know you're going to have available to pay your mortgage. And so as we're looking at your tax returns, if something like depreciation isn't a cash flow expense, well, then we don't have to worry about that from your cash flow. But if you bought a meal, even if the IRS wouldn't let you write it off, that is a cash flow expense. And I'm going to interrupt our broadcast to bring you a little bit more detail than you might want on tax forms. And so this will be brief, but I just want to give you an idea of what are we actually talking about. So if you're a sole proprietor, and a lot of solopreneurs are going to be sole proprietors, if you file a personal tax return and you report all of your income and expenses on a Schedule C, which is the form that you're looking at here, this is the math we're going to do. We start at the bottom, which is the net income that you told the IRS you earned. And then we're going to add back your business use of home, except FHA will only let us do that if you own your home, little footnote there. We're going to subtract any meals that the IRS wouldn't let you write off. We're going to subtract any income that was sort of a one-time thing, what we call other income, if it's not a recurring item. And we're going to add back depreciation. We're going to add back depletion, which you only have if you're a minor. I've never done a loan for a minor, but if you're a minor, you'll have depletion, and then you might have some depreciation buried in your vehicle expenses, and that's how we're going to calculate your income. So more than you need to know, but if you actually are interested in knowing more than you need to know, this YouTube video, you can hit that QR code. It'll take you to a YouTube video that explains some of the backstory to what I just walked through. And it'll also give you an example and you can follow along. I've got a little spreadsheet I use in there to kind of calculate income for a made up business. Now, if you're an S corporation, if you set up a corporation and you're paying yourself out of your corporation, so you're an employee, you get a W-2, but you own that business or you own at least 25% of that business, then you're still self-employed. And I want to tell you one thing that doesn't matter is your salary. Your salary doesn't matter at all. Sometimes I have folks call me and say, okay, I'm getting ready to buy a house. I'm going to give myself a raise, or they're worried, like I only pay myself the bare minimum that I need. Oh, my camera's not on again. Dang it. Okay. I don't know how long that's been. So if let's say, you're like, oh, I only pay myself what I need and my business has profits and I get those, that's okay. A $50,000 salary that you pay yourself and a $50,000 profit is the same as a $100,000 salary and a $100,000 profit, or no salary and $100,000 a profit, or paying yourself $200,000 and having your business lose $100,000. Those are all totally identical to us. We don't care. We're looking for cash flow again. And the other thing that I'll say when we talk about this, and I should have actually clicked sooner. This picture really, I think, helps to picture this, right? Your business has so much cash flow. The vessel that it's in doesn't matter, right? If you pour the profit out into the cup and you've got some wages, okay, cool. Doesn't mean there's any more profit, right? You just moved it from one place to another. And we lenders, we're not very smart sometimes, but we're smart enough to know that. The other thing that's important to know, and this is, I guess, what is important, what does matter for lending purposes is what we call distributions or liquidity. Profits from your business only count as loan qualifying income if you either distributed them to yourself, you paid them out of your business to you, or if you could have. And if you pay yourself wages and you distribute your profits, and the form you would use to do that, again, I'm apologizing in advance for showing you tax forms, but the form you use to do that is a K-1 statement. And right here in box 16, there will be a D next to any distributions you pay yourself. That's definitely income that we can use for loan qualifying. If you didn't pay yourself in wages or those distributions, then we need to figure out, did your business have the liquidity that it could have paid you that money? And we look at Schedule L on your 1120S, and we look to see if your business had sufficient liquidity. And if you don't have a Schedule L completed, if your business doesn't earn a certain amount of income, I think it's $250,000, your CPA isn't required to complete Schedule L, and they might not, then we have to look at bank statements. And so if we want to keep things, and bank statement analysis is the whole thing. So if we want to keep things easy peasy, lemon squeezy, distribute your profits, pay yourself wages or distribute them on your K-1, talk to your accountant about this, and have your accountant complete Schedule L no matter what. That keeps things much, much simpler. And if you want to know way more about how we analyze an S-Corp, I have another YouTube video for you, and you can watch that. They're long and they have lots of detail, but let's get back to more interesting stuff, our regularly scheduled programming. So, a couple of bits of good news. If your business has existed for at least 5 years, then we only have to look at 1 year of income tax returns. So, if you had a dip in income that we would have to explain and kind of help a lender understand that, nope, there's nothing wrong with your business, just, variability from 1 year to another, we can sweep that under the rug and we don't have to talk about it as long as your business has been around for at least 5 years. We can get very strategic about tax filing. So let's say you had a so-so year last year and a really great year the year before. You can extend your income tax return and not file that tax return. Some loan programs, this doesn't work, but a lot of the programs we use, that 70% of conventional loans, if we know that 2023 was better than 2024, then you could be on extension for 2024 and we could be using the better 2023 income. And you can manage, if you can, maybe invoice a little bit early. Here we are in the fall when we're recording this. If you can invoice some customers and get paid before the end of the year, things that maybe you would have kicked the can on and might have rolled in January, that can beef up this tax year a little bit and give you a little more income for loan qualifying purposes. And or, if you knew this was a really great year or you did some things to beef it up, then, maybe we wait until early next year and get your taxes filed as quickly as possible so that we can see that better, stronger year and use that for loan qualifying purposes. And if all else fails and we just can't make, all the numbers work, looking at tax returns and shuffling things around, there are options where we just ignore them altogether. We can use your 1099 statements to qualify you. We can have a third party prepare a profit and loss statement. Or, because again, what do we care about? Cash flow. We can document your cash flow using your bank statements and totally disregard, not even ask you for your income tax returns at all. And if you're a freelancer like my partner is, then there are options for you. If you're kind of in that tweener, not really self-employed, not really employed, and sometimes you get paid on a 1099 and sometimes you get paid on a W-2. As long as you've been freelance for a year, all of your W-2 income was from freelance work. None of it was a full-time job, and you're actively working at the time that you close, then we can just average your 1099s and W-2s and treat it all like one big thing. And in addition to solutions, there are opportunities as well. These are things that are kind of special to you as a self-employed person. If you get a salary, if you punch a time clock, you do not have the opportunity to really manage or control your income the same way a self-employed person does. And there are loan programs that have income limits. And if you're aware of those and you're planning ahead, you can kind of engineer your income to land in that sweet spot. And that can get you discounts on closing costs. That can help you qualify for down payment assistance programs. You can get cheaper mortgage insurance, all kinds of good stuff. And because I assume a lot of Oregonians are going to be watching this, I also wanted to mention, this isn't necessarily specific to self-employed folks, but again, you can manage your income a little bit to this if you're aware of it. There is a down payment savings plan. It's essentially like an IRA, but to save for a home purchase, called a first-time home buyer savings account, FTSA, or a lot of states call it an FHSA. And you can put up to $6,100 a year as an individual person, or double that if you're filing jointly with someone, into a savings account earmarked for a home purchase. You can put up to $50,000 into that, and you can claim a tax deduction on your Oregon income tax return for that money that you're putting into your FHSA. There is a clock with this unless the legislature renews it. You've got to open your account by December 31st of 2026, a little more than a year ago at the time, or a year from now at the time that we're recording this, and you have to spend the money within 10 years. Now, if you have business expenses and some of those show up on your personal credit report, a really important concept to play with, or really important thing to do, is try to keep your books really clean so that we can clearly identify the items on your personal credit report that are truly a business expense. If you keep a separate business account and we can show that your business has paid the prior 12 months of payments on some debt, a car loan, a credit card, vehicle loan, whatever, on your personal credit, and we can show that your business wrote off that interest, that expense was claimed as part of your business, we can disregard that debt when we qualify you for a loan, when we calculate what's called your debt to income ratio. And it can have a huge impact on how much you can qualify. $500 of payments on a credit card or $500 car loan can boost how much you can qualify to borrow by $40,000, $50,000, $60,000 easily. And I'm going to throw this out there again as something that isn't necessarily specific to self-employed or solopreneur folks. But if you live with anyone, if you have a roommate, if you have a spouse, a family member, your parents, even an adult kid, your friend from college who's been sofa surfing with you, who lives with you, or you live with someone, there is a loan rule. We call it border income, as you can see in the slide, that allows you, if you've cohabitated for 12 months and you have received rent payment or transfer of funds from your cohabitant in your home for 9 of the last 12 months, and they plan to move with you. So if it's your partner, that's probably happening. But if you have a roommate and they're moving with you, then we can add the transfers of money from your cohabitants in your home to you to your income. And a little bit, again, goes a long way. If you're just getting $1,000 a month in rent paid to you from someone who's living with you, that can boost your buying power by, pushing $100,000 in some instances. And I'm going to hand it back over to Beth. But before I do, I just want to say, if you're feeling intimidated by the process, if you're feeling like, oh, this will never happen or whatever, I promise you that the thing you've already done, which is open a business of your own and run it successfully and, do all the things that make all the sacrifices that you make to run your own business successfully, that is so much harder than purchasing a home. And this is just one more project that is entirely within your reach and entirely something you're capable of. If you can run a business, you can absolutely buy a home. You just need some of the right direction. So I'm going to take a deep breath and I'm going to hand it over to Beth, who's going to talk a little bit about today's market and the home buying process and other fun stuff. So Beth,
Thank you.
Take it away.
Yeah, so I know this screen is kind of a crazy mishmash of different numbers, but I'm going to talk about the market a little generally. But this is the latest data that we have that came out for August that kind of tells you what's going on in the market. And a big thing, kind of look down at that total market time in the bottom right corner there. We're seeing homes just sit on the market a little longer. And that's actually kind of awesome for buyers. People are having a lot more opportunity to honestly take a breath and really consider if they want to purchase a home that they've seen. They have more options. And we're also in the fall here seeing a lot more hit the market. And so we not only have these lingering listings, but we also have a bunch of new inventory hitting the market. And so you have choices, which is like not been the case for a long time. I don't know if anybody tried to look in 2021 or 2022, but it was a mad dash. Something hit the market and you just had to like run to it and fight somebody for it. And now you get to take a breath and really consider what your priorities are in home buying. So that's pretty awesome. And at the same time, we're not seeing a huge shift in the prices either. So we're being able to negotiate a lot more. We're getting some seller credits. I've negotiated a couple roofs lately. Like buyers are actually having the opportunity to ask for some things, which is pretty cool. And so I'm glad to see it. And Julie can touch on this a bit more indeed, but we've had rates slide down a little bit this last week. And, two examples that I can think of buyers that I've been working with, that payment difference was about $75 to $100 in the last week that they changed. And they could go back up, tomorrow. We don't really know where anything is headed for sure, but we are seeing a little relief in a few different categories for buyers, which is refreshing. So, all right. And then, market aside, let's talk about the home buying process. And so there are a lot of different steps. And the first thing, you've already gotten a gold star on. You have shown up and watched this video. And I think that folks can get very overwhelmed and they hear a lot of things and do a lot of different things and they don't know where to start. And you've already started. So gold star. Your next step is going to be to sit down with folks like me and folks like Julie, hopefully us specifically, and talk about, your specific situation and get get any questions that you have answered. So I love to grab a coffee or a beer with folks, and even if it is literal years away, just putting you on the right path is so impactful. And I think Julie has definitely illustrated that making some small choices with your finances over the long term can make a huge difference, especially for a self-employed person. And so sit down with us early. You are not bothering anybody by being years away from doing this thing. So and then let's say that you've gotten all those ducks in a row and you've talked to Julie, you've gotten pre-approved and you're ready to rock and roll. That's when you talk to me again and we start the search process. And so we have an actually really cool search tool. It's equivalent to like a Zillow or Redfin, and it has an app and everything where I can set you up on a search, and then you can like things, you can send things to me, I can send things to you, and we have like a nice catalog of all the things that you're interested in. And then we actually get to go and look at houses, which is the really fun part, right? Julie's often joked that she knows that she is not the most exciting part of buying a home, but I do get to do the exciting part, which is actually going to look at houses. And it's really fun to see things in person after you've looked online for so long. And thing you will learn is you can't smell through photos. There's a few different things that you learn in looking at homes that and kind of learn what you really are looking at when you're looking online as well. And so we'll do that search process. I will organize all of the tours, and then we'll get to the point of making an offer. And when we're at the point of making an offer, sometimes it can be a little heartbreaking, to be honest with you. Like, you sometimes are coming up against other people and you find that perfect home, but gosh, it's the perfect home for 9 other people. And we kind of have to fight it out. And that's where we can talk offer strategy. And it's not always more money. It can be a lot of different terms that can be really impactful to a seller. And so you're not necessarily just throwing money at it, but yeah, we'll talk about strategy. And let's say that we are the most strategic and we beat out those 9 other people and you get your offer accepted. Well, then a lot of things start flying at you. A lot of folks are asking you questions and sending paperwork your way, and we start to do inspections. And so we're going to poke around in that house and find, anything that we can that might possibly be wrong with it. And we do a sewer scope, for instance, which is kind of a colonoscopy for a house. It's a joke I like to make. And we figure out, what things you would be really important to you to have happen in order to purchase a home. So whether that's a repair or a credit, we will negotiate that with the seller, or that's a juncture we can walk away as well. And then another contingency that's kind of happening at the same time is the appraisal contingency, which has a lot more to do with Julie and the mortgage side of things, but it is another hurdle to clear before closing. Once we get through all of that, those first couple weeks are wild, and then it kind of gets kind of boring, and people are like, wait, am I still buying a house? People are just emailing me things, and you are. And so you just kind of hang out for a couple weeks. We go have a cheers and say, gosh, we got through those hard parts. And then I get to hand you your keys, like I got to do earlier today for some clients. And that's just the best day, when you get to walk into your own place and start to move in and make it your own. So that is a very simplified process. And for every person, it's going to be a little bit different. And so again, would love to sit down and chat with you more specifically about, what you're looking for and your needs, and get you on the right path.
Cool. So I don't think you can see the screen, Beth, but we are now looking at all the reasons that you might want to buy a home that have nothing to do with yes.
Yeah, tomatoes are a good reason. But yeah, I think to kind of extend off of the home buying process and all of the things that we've said today, there's so many boxes to be checked and so many processes to be done and so much paperwork to be done. And it's easy to kind of lose sight of, why is it that we like to buy homes, and what do they mean beyond all of that, or, what Zestimate is doing online and all of that. And it's apparently a place to have a whole slew of kittens or tomatoes or radishes. But no, truly, personally, we garden aggressively, and it's one of the most joyful things that I do. We have a spicy dog that doesn't like to go to dog parks, but she has her own dog park, which is our backyard. And so there are so many things that make a home worthwhile beyond all of the business of home buying. And so don't lose sight of that as you look at buying a home.
For sure. And as we are just going to kind of be a little redundant here and say, the number one thing that we can do really is help with planning. I think particularly with the lending side of things, because A, it is not the thing people look forward to in the home buying process, and I absolutely know that. And B, I think a lot of times, I have conversations often where people are like, well, I don't really want to bother you, or it's not really time to talk to you because I don't know that I want to buy a house yet. So talking to a lender doesn't make sense, or talking to a real estate broker doesn't make sense because I'm not in the market. And my retort to that is, how on earth are you going to know that you're in the market or that the time is right if you don't get the information that a lender and a real estate broker can help with? And so we want to help with that. We want to help you with the information gathering. We want to help you kind of mull through and focus your goals and create a roadmap that you can use to plan whatever the timeline is. If it's something that you can do immediately, if it's something that's going to require laying the groundwork for 6 or 12 or 18 or 24 months, that's exactly what we're here for. It's a big part of what we do. And it really kind of gives us joy to, the reward is so much sweeter when you have to work for it a little bit. So anything you want to add to that, Beth?
No. Definitely. Earlier the better, I think. Yeah. I often hear I don't want to bug you yet. No, you're not bugging anybody. So
yeah,
folks sure. Get a plan in place. That is huge.
Yeah, wonderful. Well, I'm going to put our contact information up on the screen along with QR codes that you can use to schedule a call or a meeting with either one of us. So our contact information is up there. And I don't know, Holly, did you have anything you wanted to add, or shall we call it a day?
No, we can close it out. Thank you so much, Beth and Julie, for putting this together for us and for being a great resource to folks like me who are just trying to make it work on our own.
Yeah, it's a pleasure and an honor, and I'm self-employed folks are kind of my people. Like I was raised by wolves, I guess. Somehow turned out not to be self-employed, but y'all are the most creative and energetic and wonderful clients to work with, and we love working with self-employed and solopreneur clients.